What do you call it when the world's largest economy borrows $4 million every minute, right as its biggest creditor walks away? Imagine this. The U.S. enters Q2 expecting $850 billion in cash. Instead, it finds just half. At that very moment, China unloads $1.7 trillion in U.S. treasuries, torches the dollar, and forces Washington to borrow $514 billion just to stay afloat. Mortgage rates spike, inflation surges, allies retreat, and suddenly, U.S. debt stops being safe. This wasn't a glitch. It was a global signal. What happens next could rewrite the rules of economic power. At its current pace, the U.S. racks up over $4 million in debt every 60 seconds. But that burden grew exponentially when China began liquidating its treasury holdings. Beijing sold off $1.7 trillion in U.S. bonds, triggering an emergency borrowing surge that forced the Treasury to raise $514 billion, a 317% increase over its February forecast, according to Bloomberg. The sell-off came in response to Washington's move to block U.S. banks from participating in the IPO of a Chinese EV battery firm. The policy shift, seen as a weaponization of finance, prompted an aggressive counterstrike. The dollar fell 9%. Yields jumped. Gold soared. Global investors fled dollar assets. Now the U.S. is financing geopolitical maneuvering with money it doesn't have. And the world is starting to wonder, can Washington even afford its own strategy? When J.P. Morgan and Bank of America were ordered to pull out of the $5.3 billion IPO for China's top EV battery maker, the damage went far beyond lost fees. The 0.2% underwriting margin was minor. But Reuters noted that the long-term cost of losing access to China's financial markets could run into the billions. This wasn't a routine IPO. The firm had ties to strategic technologies and, under Section 126 of the Defense Department's designation, was linked to China's military-industrial complex. The banks withdrew under threat of U.S. regulatory backlash, but China's response wasn't just diplomatic. It was financial. Beijing slashed its U.S. Treasury holdings to $759 billion in Q1 2025, the lowest level since 2016, while raising gold reserves to 2,292 tons, marking 5 consecutive months of accumulation, according to the People's Bank of China. This move aligns with a years-long effort to de-dollarize its reserves amid escalating geopolitical tensions. IMF data shows the dollar's share of global reserves fell from 64.7% in 2016 to 57.4% by Q3 2024, a clear trend. Unlike past sell-offs, this wasn't a market reaction. It was a structural shift, a declaration of independence from U.S. fiscal policy. So what happens when the world's second-largest economy starts treating treasuries not as lifelines, but liabilities? The Treasury entered Q2 2025 expecting $850 billion in cash. It had just $46 billion, less than half. That shortfall, worsened by the return of the federal debt ceiling in January, forced unexpected borrowing. According to Treasury statements, borrowing would have been $53 billion lower had the cash buffer held. But the real concern is why officials stuck to outdated projections even as liquidity dried up. Bloomberg reported that Wall Street was bracing for a $255 billion borrowing figure, not double that. The gap raises critical questions about whether fiscal policy is being steered blind in real time. Some analysts, including Wrightson and IAPS's Liu, speculated that President Trump's tariff hikes could offset the damage by boosting Treasury receipts. But early indicators suggest otherwise. Apple warned of a projected $900 million tariff-related hit in Q2 2025, prompting internal talks to raise iPhone prices. Meanwhile, consumer inflation surged to 3.4%, up from 2.2% the previous quarter, driven largely by higher import costs. This isn't a blip. It's a structural squeeze. As imports fall and corporate margins shrink, tax revenue may not keep up with the soaring interest burden from rising yields. If tariffs were meant to stabilize the books, early numbers suggest they may instead be tightening a fiscal noose. Behind every Treasury auction is a family paying more for less. With China's exit from U.S. debt markets, yields on 10-year bonds climbed past 4.6%, reaching 6% by May 2025. Mortgage rates followed, hitting a 15-year high of 7.8%, according to Freddie Mac. Auto loans breached 9.1%, and average student loan rates reached 6.6%, eroding affordability across nearly every sector. The Consumer Price Index rose 3.4% in Q1, up from 2.2% the previous quarter, with food and energy leading the surge. That's not just economic friction, it's real-world compression. Bloomberg reported household purchasing power dropped 5.1% year-over-year, hitting middle-income families hardest. As essentials imported from abroad are now priced against a weakened dollar, costs are climbing fast. And with the dollar down 9% since Beijing's bond sell-off, the pressure on consumers continues to build. But here's the bigger problem. As Washington's financial decisions ripple outward, it's not foreign investors who absorb the impact, it's the U.S. consumer. In the wake of China's retreat, U.S. allies have begun moving cautiously. In Q1 2025 alone, foreign investors sold off $317 billion in U.S. assets, the largest capital flight since 2016, according to Treasury data. Saudi Arabia, once among the top 10 holders of treasuries, cut its holdings to $126.4 billion, a 22% drop from mid-2024 levels. At the same time, a bipartisan mandate in Congress required BlackRock and Vanguard to divest $812 billion from 220 Chinese companies, further politicizing global capital flows. The result? Asian IPOs on U.S. exchanges collapsed. Just 28% of Asia-based firms chose U.S. listings in 2025, down from 75% 3 years prior. The Wall Street Journal reported Tokyo and Frankfurt seeing a corresponding rise in listings and bond demand. The U.S. isn't just losing investor confidence, it's surrendering its monopoly on global financial trust. And here's the danger. The quiet retreat of allies is often harder to detect than outright defiance, but far more dangerous when it compounds. While Washington leans on debt to fund both policy and posture, Beijing is building exits. In 2026, China will launch its own national credit rating system to bypass Moody's, S&P, and Fitch, rating agencies that, according to the China Institute of Finance and Industry, have cost Chinese state-owned enterprises up to 120 basis points in excess borrowing costs despite stronger fundamentals. Simultaneously, China is upgrading its domestic cross-border payment systems to reduce reliance on SWIFT, the U.S.-dominated network vulnerable to sanctions. And BRICS Pay. It processed $56.4 billion in Q1 2025 alone, nearly half in local currencies, according to Bloomberg. These aren't fringe experiments. They're systemic shifts, architected to insulate Beijing from Western pressure. As more countries plug into China's financial orbit, the question grows. Does the U.S. dollar remain the world's currency, or just a regional one propped up by legacy status? The Treasury's revised borrowing plan reflects the strain, $514 billion for Q2 and $554 billion projected for Q3, premised on restoring a cash balance of $850 billion. But as of mid-May, the balance stood at just $563 billion, up from March's $46 billion, yet still 33% short of target, per the department's Monday statement. J.P. Morgan analysts warn that assuming a clean debt ceiling resolution is increasingly optimistic, noting markets may not tolerate the growing gap between fiscal promises and cash realities. Rating agencies are beginning to reassess the U.S. sovereign outlook. Wrightson and IAPS's Luan cautioned that Treasury's current cash management strategy may require a full-scale reset if Congress fails to act. With BRICS building alternatives, China shedding dollar liabilities, and even traditional allies hedging exposure, the U.S. faces a binary choice: reform its fiscal and geopolitical stance, or watch the foundations of financial dominance erode, not by force, but by design. These numbers aren't abstract. They're unfolding right now. Mortgage rates are rising. Investor confidence is fracturing. The global economy is quietly shifting its center of gravity. Beijing isn't waiting. BRICS isn't hesitating. And Washington is still betting that legacy power will be enough to hold the system together. But the debt clock doesn't pause for politics. And markets don't trade on nostalgia. So ask yourself, what happens if the next Treasury auction doesn't go as planned? What if allies stop calling U.S. bonds safe and start calling them exposed? Drop your thoughts in the comments. Because what's coming next, from interest rate shocks to reserve currency realignments, may force every nation, company, and household to pick a side. Subscribe now, hit the bell, and join us as we track the unraveling or the rebirth of America's economic leadership.